Welcome back. Today, we're going to challenge one of the biggest rules in personal finance. We're going to explore a whole new way to think about your money, one that swaps all that market-induced stress for some predictable calm. So let's dive right in. You know, we're all told the same thing. To grow your wealth, you've got to be in the stock market. Buy stocks, get some mutual funds, and just watch your money grow. But let's be real for a second. For a lot of us, that advice comes with a heavy dose of constant anxiety, doesn't it? That feeling, that tension between the promise of growth and the reality of anxiety. Well, that creates what we call the investing dilemma. It's the core problem we're going to unpack right now. So first, let's just make sure we're on the same page. When we say traditional investments, what are we even talking about? Well, it's things like stocks and mutual funds. The basic idea is pretty simple. You're buying a piece of something today and you're hoping, really hoping, that it's going to be worth a whole lot more down the road. And this right here, this is the fundamental dream of it all, isn't it? You put in $1 and through the, magic of the market, you hope, and hope is the T word here, that it somehow turns into $10. Sounds simple, right? Well, maybe not so much. Because that simple dream, it's got a flip side. For many people, it becomes a real source of trouble. So let's break down the three key problems that come along with this traditional way of doing things, okay? Problem number one, it's the biggest one and it's the most obvious. The stock market is just wildly unpredictable. I mean, you can do all the homework in the world, but at the end of the day, nobody, and I mean nobody, truly knows what's going to happen next. This isn't just a feeling, it's a fact that history keeps proving. In 2008, people watched the retirement funds get cut in half, practically overnight. Then in 2020, the COVID crash wiped out 35% of the market's value in a flash. So what about tomorrow? That question mark really says it all. So you might be thinking, okay, I'll just avoid all not craziness and play it safe. That leads us straight into the second problem. When you go for those super low risk options, you're pretty much guaranteed to get super low returns. What's so powerful about this chart is how clearly it shows the trap you put your money in a quote unquote safe bank account and it's earning maybe 1 or 2%. But then look at the other bar. Inflation is often chugging along at more than that. So you're not just getting a low return, you're actually losing buying power. You're going backwards. So if low risk doesn't really work, what about chasing those big returns we all hear about? Well, that brings us right to problem number 3. High returns are almost always tied to high risk, which, you guessed it, translates directly to high stress. And that stress is the real deal. We're talking about losing sleep at night, worrying about what the market's going to do. It means being glued to your phone, just compulsively checking your portfolio. And it means living with that constant nagging fear in the back of your mind that you could lose a huge chunk of your hard-earned money. It really starts to feel like a no-win situation, doesn't it? Just this cycle of unpredictability, poor returns, and straight-up anxiety. So the big question is, how do you break free from it? What's the solution here? Well, the answer really lies in shifting your entire mindset. It's about moving towards something we call a passive income structure, which is a strategy that is all about creating predictability in a very unpredictable world. So what is this thing exactly? A passive income structure completely changes the question. You ask your money, instead of asking, how can I find the next hot stock and get explosive growth? The question becomes, how can I design a system that manages risk to generate steady, reliable income? It's a carefully built strategy where the goal isn't just a big number on a screen, but a consistent, predictable cash flow. It all boils down to two simple but really powerful pillars. First, you actively manage and control the risk that comes before anything else. And only then, once you have that foundation of safety, do you focus on building a steady, reliable stream of income. And when you start to see it this way, the choice becomes so much clearer. It's really a decision between two fundamentally different financial paths, and one of them can lead to some genuine peace of mind. I mean, this table just lays it out perfectly. On the left, you've got traditional investments, the risk totally unpredictable, the returns all over the place, volatile. And what's the result? Stress. But then look at the right side, the passive income structure. Risk is managed, returns are steady, and that leads to a much calmer result, peace of mind. So the most important takeaway is this. It's a profound shift in what you're even trying to do with your money. The goal is no longer about trying to get rich overnight. The goal is to build predictable, reliable income that lets you actually sleep at night. Now take a look at this number, $12,000. And just so you know, this isn't some hypothetical figure. That is the actual monthly income a real client was able to generate from a $1.5 million investment using this exact kind of passive income structure. So how'd they do it? We are going to break down that exact case study in our very next explainer. You are not going to want to miss it.